Hello, everyone. Good evening. This is Apeksha Desai. Welcome to Buoyant Capital webinar. Over the next hour, we shall present our views on the markets going forward and how Buoyant is positioned. The presentation shall last for about 40 minutes, and we will then open the floor for Q&A session for about 15-20 minutes. In between, please feel free to post your questions in the Q&A box, and we will take them up once the presentation ends. With that, let me yield the floor over to Jigar. Jigar, over to you.
Yes, thanks, Apeksha, and thank you everybody for joining in. Good afternoon. Thanks for taking the time to join this webinar today. Over the course of the next hour or so, we shall be discussing on how we are seeing the markets going forward and how are we basically as Buoyant Capital positioned for that. Let me start the slide deck. Apeksha, please let me know once my screen is visible, please.
Yes.
All right. So let me start with the first slide. Now, for those of you who have met us earlier, sort of you understand what this image signifies for us. You know, waters may remain choppy, but it's our intention to become the sea buoy that keeps the direction and the buoyancy alive. For those of you who haven't met, now the questionnaire on the Zoom was basically people who are interested. So in the next couple of slides, I'll quickly run you through who we are and what we have done. So basically, the fund was launched in 2016. We are almost in the 7-year and 6th month of this. As we speak, we are currently managing close to 2,000 crores under a single strategy. It comes in two vehicles, PMS and CAT3 open-ended AIF. Fourth, we run only one strategy. That's a truly sector agnostic, market cap agnostic strategy. Fifth, we don't run a model portfolio. We do not think that is the ideal way to run PMS money. Fresh money accordingly is treated differently and invested as the market presents itself. And lastly, I'd say that the skin in the game is reasonably significant. Buoyant and its promoters co-invest in the same fund. Very sort of swiftly, the framework and process is for those who have met us, you understand this. The framework basically depends on the cycle stance. We are either aggressive or defensive, and basis that the core versus satellite portfolio weight allocation changes. The process actually is as follows. We start with a top-down approach, a macro view on where we are headed that leads to the sector selection. Macro view plus cycle stance basically dictates where we go as sectors. Then comes the stock selection. That's the analyst prerogative covering this. That presentation is done to the investment committee. And that's how a stock selection happens. That when you combine with the exit decision, which is basically thesis based, dictates the buoyant portfolio. And the aim clearly is to keep generating a superior risk adjusted return. Coming to the key debates at hand, and I think that's where we start. I think as we see, the things that are presented to us, we can sort of classify them in 4 broad parameters. One is, where the global markets are headed, and especially the debate is around the US interest rates. There is a lot of short okay, just checking up. Is my video visible? Okay. Sorry about that. Let me in between it sort of keeps coming and going, but let me. Right, so the key debates as we see them are broadly classified into 4 areas where the global markets are headed, especially the US interest rates. If we get turned on into the daily basis of noise that gets poured out, it's very difficult to get a perspective on where that really is. Secondly, where do we see the Indian markets headed? Can we truly decouple? The third is how is the portfolio sort of structured for that? The fourth part is the changes that we are following and portfolio changes in the last quarter especially. Let's sort of dive into the global markets. I've again segregated them into US interest rates and the Israel Hamas conflict. US interest rates, very interesting. Let's sort of start. As I said, if you start getting into the daily ins and outs, that becomes a little bit difficult on getting a very clear track on where things are headed. So let's take a step back, look at sort of where things are presented to us at this juncture. And here I'll start with a sort of uncharacteristically strong comment that the Fed, we do not think, really wants lower, inflation at all costs. This might sound a little bit surprising, but let me run you through what's really transpired over the last 50 years or so. And in the first sort of few years of its formation, the gold standard did hold through for a significant amount of time. But in the 1970s, when that was disbanded, after that, we essentially came into sort of a bipolar world. The USSR and the United States of America became the two superpowers, and that conflict remained for a little bit of time until December 1991, when the USSR flag was sort of hoisted down of the Kremlin, and the Russian flag was hoisted up. And post that, it became a truly unipolar world with one absolute power, that is the United States of America. But since 1998, a few amount of years passed. But since then, US sort of power started getting consolidated, and they have taken a significant amount of, in exorbitant privilege that power offers. And because of which you are seeing the amount of pressures that we are witnessing today. And eventually that needs to be reset. Lower debt to GDP is a painstaking process, but that's where we are headed, in our opinion. Now, this is sort of a very interesting chart. This is the Fed Reserve's balance sheet. As it's apparent, we were at around the $1 trillion mark until 2008. And even in the global financial crisis, we only added about 1 trillion in net debt. So Fed balance sheet actually grew only from $1 to $2 trillion. But then you are seeing the kind of steady increase that has been sort of lifted. COVID was another time when the balance sheet jumped from 4 to almost $7 trillion. And since then, it has kept on rising to almost 9 trillion. And only now there have been efforts by the Fed to cool the base off. But why was this possible? This was possible because essentially there was no alternative. Right now, it might surprise a few people again that it takes only 8.6 cents to print a $100 bill for the US, whereas other countries continues to manufacture that amount of goods and hand it over to the US. Now, imagine, India, China essentially, working very hard to produce the goods for their $100, whereas US continuing to print it. And eventually, the reason why that increased was because there was no competition. Euro is sort of a bank without a state. Imagine in India, Tamil Nadu, Maharashtra, all continuing to borrow at will, and then all of them continue to enjoy a sovereign credit rating. That is not a sustainable solution. The reserves in the share of euro in reserves is still only around 20%. Japan has a very wide yield control. China, not a lot of people trust. India doesn't really have a full capital convertibility, and BRICS doesn't have a currency. So essentially, there were very limited options. The pound sterling actually declined a lot, and therefore, US continued to stay at the helm. And in the recent times, we have seen increasing evidence of Treasury and the Fed acting differently. So Fed will say something else, Treasury will do something else. And essentially, that brings us to the conclusion that they do not want to bring down the inflation at any cost. The whole idea is to keep the debt to GDP number lower. And if they are able to do that, the only way they are able to do that, and this chart shows exactly how the debt to GDP number itself has grown. In the recent downgrade that we saw, they were not so much worried about anything else other than the 131 odd percent debt to GDP number. Since then, that number has come down, but you need the inflation to essentially stay higher. And for the inflation to stay higher, they cannot really go ahead and crush the economy. So Fed will essentially do and cut down the size of its balance sheet. They did that starting Jan 2022 to October 2022. Post that, the treasury came in, the liquidity is managed at both the treasury and the Federal Reserve's base. And from that standpoint, they were basically cutting down on the flows, and the treasury started increasing the flows. So this chart essentially gets you a perspective: Fed cutting in, treasury increasing. In between, Fed will come in, and if things look very somber, they would want to keep the liquidity higher again, and then cut it down again. So the short answer to this is that we are going to see continually shorter and shorter cycles play out. The interest rate is here to stay at a higher level for a very long period of time. The second question clearly on our minds is the ongoing Israel-Hamas conflict. Clearly, it's a very huge humanitarian crisis. Any loss of life is really tragic. But having said that, it's not really Russia-Ukraine, right? Russia-Ukraine was very different because Ukraine was the wheat basket of the world. The bread basket is rather what it was called, a large amount of fertilizer production as well. And the Western Bloc was against Russia, which is a very large producer of oil. Here, essentially, sort of the Western Bloc appears to be alongside Israel. And unless Saudi sort of joins in, and there are very limited evidence to suggest that they want to join into the conflict, as we speak, they are actually having discussions with the US defense secretaries. And from everything, it looks like that this won't really get into a really large oil imbroglio. And in that case, India will continue to remain relatively resilient. Unless oil moves beyond $9,500, that's not something that calls for our immediate attention as far as the market is concerned. Again, that brings us to the next question on where is India? Is India truly decoupled, and what are India-specific issues? Let's break that down in 3 or 4 points. One clearly is the 10-year framework. Second is the flows. Third is actually how are we joined at the hip at the central bank level, and what that means in terms of interest rate differential. Right? Is India truly decoupled? Yes. So from, say, a 10-year perspective, we are likely seeing things that actually changes the destinies of countries. Right? Over the course of the chart that you're seeing is the labor force participation. Today, from around 83 odd crore people, we will go above 100 crore people in the next 20 years or so. And whenever this has happened with countries, something like 20% of the population joining the working age group, they actually lead to a dramatic change in the fortunes of the countries. Uh, One argument to think about this is that, oh, there are no jobs. What essentially are all these people going to do? The other way that we prefer to look at it is that, look, today they are just drawing from the national reservoir. Tomorrow, even if they start doing any sort of job, maybe not suited to what they would want to do, but any sort of a productive job, it adds to the working age population, and they start adding to the reservoir of the country per se rather than drawing from it. 20% of the people doing it leads to dramatic changes. The second is basically productivity gains start coming in. India is, a top 5 country in terms of absolute GDP. In terms of per capita GDP, however, we are number 127. And from that perspective, it is very difficult to imagine 62% of the GDP coming from services. That a typical template for a country to grow is that your labor cost is cheap. You become the manufacturing hub for the world. And becoming the manufacturing hub allows you control over your current account. You export more than you import, and you strategically invest this current account into your vulnerabilities. In India's case, that's clearly oil. Clearly, none of that has happened as we speak in India. 62% coming from services. We had Narega and Manrega. We continue to have that. So labor was never really cheap, and that led to a very sort of disproportionately low manufacturing state. In the 80s, we were still large on pharma API, etc., but we gave that all away to China eventually. Now, what the government is doing in terms of PLI, it is our estimate, they are tracking it very closely, and it's our estimate that it will lead to large-scale productivity gains and some amount of employment as well. Now, when you combine those two factors, the first is the labor force participation, the second is the productivity gain. that essentially becomes the fundamental bedrock of your economic growth. And once that is in place, you start attracting a lot of flows. We expect reasonable amount of flows. India's invested savings in the early 90s was at around 20% plus. So amount of household savings coming into equities directly. That number went down to 5 or 6% by 2015-16. It's one thing to see a drawdown. It was all up to another, seeing multiple scams play out 1992, 1998. And then people just lost interest in equities. That's slowly turning around. And that is very, very visible in the kind of numbers that you are seeing, especially towards the later months, when domestic investors and mutual funds are taking the sort of control of the way in which the economy is growing. So, when you combine all of these three things, it broadly paints to a direction that if the, fundamental fabric of the economy is strong, fund flows continue to be reasonably high, then equities over a longer term present a very interesting opportunity, no two ways around it. However, you know, we need to look at the path to that long term. What's actually happening is that we are seeing a lot of these cycles, fundamental economic cycles, play out, and not a lot of attention being garnered to that. To that end, let me bring it to one last point about the India's economy and then bring in the issues at hand. This is a very interesting chart. What we are comparing is the two policy rates, the Fed fund target rate upper bound, that's the dark blue line below, and the repo rate, which is India's policy rate. You look at the differential, right? Today, the repo is at 550. The repo is at 650. The Fed fund target rate upper bound is at 550. And the 100 basis point differential that we are seeing is the lowest we have seen in 23 years. Right? So RBI has clearly done an incredible job of bringing this down. In COVID, we were, as it's evident here, we were at 400 points. In 2013, when we were the fragile five, we were at 800 points. So borrowing costs in India vis-a-vis every other country has meaningfully come down. But this again brings a lot of questions to mind, especially what if oil sort of goes above a certain trajectory, right? As a country, we import 1.7 billion barrels of oil. Oil moving up by $20 will cost us somewhere around $35 billion to the current account. That's more money, by the way, compared to what the JP Morgan bond inclusion will bring us in. And that is more amount of money than the sort of FDI that we are pulling in. So if the current account deficit widens, your FDI at the gross level is at a reasonably higher level. But the FDI net still continues to be at a 10-year low because there is a huge amount of promoter selling. Promoter here is classified as those VCs which are selling out of the IPOs that are being handed down to us. And at the same time, the bigger issue to consider is that we have $274 billion of short-term maturities due over the next 9 months or so. Now, if this maturities, see, traditionally when the interest rate differential was large, a lot of promoters would not have really bothered worrying about getting that refinance from India. But if the inflation differential, if the interest rate differential is so low, then essentially it creates some amount of problem as to why you would not want to get that refinance from India. So that's one emerging risk, and RBI is looking at driving this car, just monitoring the FX reserves. The inflation is pretty much under control. The interest rate is being driven looking at FX and FX reserves. And as long as that continues to be in place, that's a reasonably decent position to be in. But all this good news, the real question is what is factored in. And I think this is a very interesting chart. What we have done is that we have taken the period between April and September. We have looked at companies with more than 500 crores in market cap. And this is a frequency distribution on how the share price performance of these have behaved. Right. So you look at this, of the 1,250 odd companies, the ones that are up to 30% are 460. The companies that are up between 30 and 50 is 280. but close to 300 companies are up more than 50 to 500%. Correct? Look at the number between 70 and 100%. 121 companies, of which 84% are classified as small caps. Up 100 to 500%, 87% of these are classified as small cap. So my argument is that, part of this is being factored in as we speak. 10 years is still a great story, but the path to 10 year can be a little bit tumultuous. And that is where, the cycles that come into play. The indices one is what I'm presenting here, and very interesting. See, look at it from this perspective that over 20 years, the small cap and Sensex as an index returns are not very dissimilar, right? They're more or less around the same vicinity, but the returns have not come in at the same trajectory. Look at the period between December 17 and March 20. The large cap index, which is in the green, was down something like 12%, and the gray, which is the small cap index, was down 50%. Right? We go back to that time, we start looking at it. It appears like there was this narrative that in India there are only these 20 great quality investment companies worth investing in. FIs will only invest here, domestics, no FIs will only invest here. So this is the be all and end all of investing. But then the cycle turned around, and all of us are witness to what's really happened to the small cap space post COVID, right? The outperformance has been simply staggering. And even in the past 6 months, as I have shown, a large amount of these small caps have gone up dramatically higher. So the argument that we are working with is that yes, over the longer term, things continue to be reasonably resilient. Equity exposure needs to be high, but the path to that can be worked out better in terms of cycles. From that perspective, before sort of I move on to where how is Buoyant Capital position, we keep getting this question as to how important is the state political season into this, right? To that end, obviously the image shows our point in view. We are no experts, we don't really know, but just taking a bit of a cue from the history might throw in interesting ideas, right? So you look at Karnataka. So what you're seeing in percentage terms are the seat share percentage, not vote share, seat share percentage of the state elections, and then the 2019 general election. In Karnataka, NDA was still the leader, got 46% of the seats. But in 2019, the general election, they got 25 of 28 seats. In Chhattisgarh state, NDA got 17% of the seats. But in the general election, they got 9 out of the 11 seats. Same with Madhya Pradesh, less than 50% vote, nearly a clean sweep at the general election. Rajasthan, 37% vote share, nearly a clean sweep. So I think the Indian electorate is sort of become mature enough to tackle this situation on how we are addressing this as a polity. They want a certain party at the state because of the local issues. And even if there were sort of a negative local issue, I've taken 4, I've not taken Telangana and Mizoram. That BJP doesn't really play a big part, except the municipal elections in Telangana. But I think this would probably end up being a non-event as far as the general election is concerned. That brings us clearly to how we are looking to handle our portfolio, the changes that we are making over a longer term duration. And my intention is to show a few charts as to how we are positioned. And then the specific changes, the stocks that we have added and reduced over the course of the past 3 or 4 months. And then I'll end it with just the performance for the month. Here, I think it is incumbent on me to give out a crucial disclosure. I mentioned at the start of things that we don't run a model portfolio, right? Imagine you have 25 stocks in your portfolio. Not all 25 are buys every day the money is hitting the account. A lot of asset managers, still follow this copy paste model because logistically it's a nightmare in order to run different portfolios with varying weights. But sort of we started working with an IT company. We now have a full solution in place in a way where we are able to manage new money differently vis-a-vis the old money. So what I'm going to show is at a broad portfolio level. Your portfolio may not be exactly similar. If it's old money, then it's not going to be hugely different. But if you are a recent investor with us, this might not be completely reflected in your portfolio. But having said that, this is what the broad market cap categorization looks like for us. I'll zoom into a few events and then it becomes reasonably apparent. So we are decisively moving into larger caps. Correct. Post COVID, we were reasonably large, almost 60% plus into small and mid caps. In September 2021, we had started becoming defensive. We had started reducing exposure to small caps, taking more exposure to larger caps. That essentially evened out once we became we were defensive and the Russia Ukraine dust settled. The portfolio was even Steven. But then, the post budget small and mid caps were available at a reasonably cheap valuation. We went again 60% into small and mid caps. With the rally that has transpired, we essentially are getting and moving back into larger caps and cash. The component of cash, if the fact sheet will be released in a couple of days, is slightly elevated because we are attracting reasonable amounts of fresh capital and we are telling most of those investors that we will take time to get fully deployed. But even when taken as a combined number, you look at the position from May 2023 to October 2023 has essentially changed dramatically. Let's look at another slice of events, which is core and satellite, which is where we manage our fund differently as well. Now, pre-COVID, we were again very, very aggressive. By September 2021, we had become defensive, so core and satellite were even. But when we turned defensive post Russia Ukraine, the core started taking a much higher piece. Even in May 2023, when we had become sort of post budget tactical, the small and mid cap exposure was higher, but core continued to remain high. And today, as we speak, core and cash truly is at a reasonably high level. We are almost touching 70% on this metric. And satellite, which is the part when we get aggressive, is something that we are managing very carefully. Pointed changes in our portfolio, the top weight additions and deletions over the past 6 months. We have added three key names. One is ICICI Lombard General Insurance. Viral covers that. What we believe is, that there will be an improved growth in the preferred segment, especially motor and health, and the operating leverage will drive the cross ratios better, leading to a healthy growth in the reported profits. So clearly, we continue to own the life insurance part, but we are adding some exposure to the motor and health insurance as well. Avas is a relatively new addition in the portfolio. The stock had corrected after the change in management. The asset quality continues to remain pristine. The valuations have become undemanding after the stock corrected. And the affordable housing as an opportunity is a very interesting part. So that's one place that we have added a new exposure. And the last part is RR Cable. It's a recent listing. It's among the fastest growing companies in the wires and cables industry. And margins sort of are at the trough level, marketing as well as fast moving electrical goods. The products continue to rank very highly with growth in top line and bottom line is what we are expecting. In terms of key deletions, there are three plays. One is IDFC Limited. That stock we have owned for a fairly long period of time, number of years. The thesis clearly was that the small banking universe will continue to grow. Your holding company, the legacy borrowing cost will come down meaningfully, and your holding company will eventually get collapsed. Now, as the thesis has played out, the stock has run up beautifully well. The re-rating has more or less happened. There is still slight bit of difference between the announced ratios and the ratios that is presented at the listed price. But I think a large part of the story that we wanted to play has played out. We have not completely sold in, but this is a place where we have reduced exposure. The second is Kotak Mahindra Bank. Again, we had owned it for quite a while, but incrementally we are moving weights to HDFC Bank. HDFC was never a meaningful part of our portfolio until last year. Last year, I think the market continued to view it very, very negatively for multiple years, and the merger in most probabilities will take a reasonable amount of time to get some sort of a closure. But until that happens, we are happy to, being defensive, wanting to go into larger caps. Within larger caps, we believe HDFC as a franchise offers a better value for money than Kotak Mahindra Bank. And lastly, we moved out of Bandhan Bank. That is again a realignment of wage. The MFI was a cyclical play for us that played out. It was part of our core portfolio. And in the process of moving, excuse me, it was part of our satellite portfolio. And in the process of moving out of satellite and into core, we sort of we sort of sold Bandhan Bank. The last point I will make, and then maybe 3 or 4 minutes on performance. So we look at it from multiple standpoints, and here I'll zoom in. So what we are comparing is Buoyant portfolio vis-a-vis the BSE 500, which is our announced benchmark, but we have put in Nifty total returns and BSE 100 for a good measure as well. And more than 1 year returns are CAGR returns, 1 year and less are absolute returns. So as it is apparent over the last month, because the market was dramatically down and we were defensive, we were able to protect the capital reasonably well, which actually takes our 1 year returns at almost 3 times the market returns. The Nifty and BSE 100 were actually lower. 2 year, again, it's almost 2.5 times. 2 years, we are close to 2 times. And since inception, we are close to around 750 basis points alpha post fees and expenses, which when compounded for almost 7.5 years is almost 341% returns versus 172. But here is where it gets interesting, right? The beta of our portfolio is 0.92. Correct. So statistically speaking, we are taking much lesser risk compared to the market, but still are able to generate almost 3 times market return. Over 3 years, clearly, we have taken higher risk immediately after COVID that takes the ratio at an elevated level. But even then, we are close above 40% CAGR on a 3 year basis. The last point I would like to mention here is in terms of rolling returns. See, point to point returns are great, but they don't really tell a very large tale of the consistency of the returns. To that end, we would like to evaluate the returns on a rolling return distribution basis. So let's say we started the fund on 1st June 2016. At the end of 30th May 2021, we would complete the first 5 years, right? So we'll take it as one observation. Then we run the same exercise all over again, starting the portfolio from 2nd June to 2nd June 2016 to 1st June 2021. And combining that for almost 28 months, close to 800 observation, we create a frequency distribution that hopefully tells the story of how consistent the fund has been. So empirically speaking, let's say you came in at any time you wanted to sort of stay on for 5 years or more, the empirical probability of having generated more than 6% CAGR is 100% both for BSE 500 total returns as well as for Buoyant. But the moment you increase the return threshold to 12.5%, the drop in the sort of Sensex BSE 500 number of observations is perceptive, whereas the number for Buoyant continues to remain at a reasonably higher level. Similarly, raising it to 17.5%, the index all but vanishes, but we have been able to maintain a reasonable presence. So if I may say so myself, not only are the returns higher, they are a lot better on a risk scale and a lot more consistent as well. The other way to look at these numbers clearly is the breakdown. And I think instead of year over year numbers, we like to look at it from how we have done on a per cycle basis. So we started the fund in June 2016. We ran it in an aggressive fashion till October. The light gray is the Sensex bar, the dark gray is the mid cap bar, the darkest gray is the small cap bar. So the Sensex was at something like 20%. We did 63%. We then became defensive. The long-term capital budget came in Jan-Feb 2018. Post that, the broader market went down, but Sensex was held up by a few names. Our idea was to protect the capital, which we did. Then we became aggressive again, generated 72% returns. We became defensive in August, September 21. And since then, we are sort of beating all the indices, small, large, and mid cap. But the idea is always to keep this number positive. correct? So that is the stance broken down in cycles. Last point I would like to mention is that, we, if you like reading, we like writing. Uh, every week we try and write an article in the Economic Times. We have written 126 articles so far, and here we take a very nuanced call on important topics. For example, in 2021, when the tech stocks were moving up and everybody wanted to buy them, we argued how they are not really a play on India as much as they are a play on the US treasuries. It was a very dichotomous statement to make at that juncture, but we could put the argument across that look through a SoftBank, look through a Tiger Global, their end investors were endowments. And the moment interest rate hits 3%, not only will the endowments which are seeking a 3% on a 30-year paper will run away, but try discounting an ultra high duration cash flow stream at a 0.25% US risk free versus 3% US risk free. The fall in value was at least 50%, if not higher. While that has transpired, last month we have written an article how credit cards could actually become a defunct business in 10 years once the India stack is fully implemented. The Jandan Aadhaar mobile trinity is just the first part of this. Eventually, it is going to get into account aggregation, data democratization, and eventually loan democratization. And at that point in time, credit card would turn into a very difficult business. So, over 126 articles we have written on IT, SaaS, pharma, FMCG, credit card, bank, retailing, utilities, electric vehicles, cement, aluminum, steel. So a lot of views other than the markets we carry in the blog slash articles. A lot of views on the market are carried every month on the fact sheet, and all our media interviews we have ever given, they are tabulated, they are put up on the website. You can see the website on your screen now. The general disclaimers lay, and we have welcome you to sort of watch us there. So I think this is what I wanted to present. I'm not sure if Apeksha is back. Yes, she is back. So very happy to take questions if you have them, please.
Thank you so much, Jigar, for this presentation. We will now open the floor for Q&A. Jigar, I think you'll be able to see the questions on the Q&A box.
Yes. Yes, so we will sort of take it as we go. But if there are Apeksha sort of live questions, please feel free to raise your hand and we will unmute you to ask a few questions. So we have the first one from Jignesh. I'm unmuting you, Jignesh Shah. Yes, please go ahead, Jignesh.
So my questions were mainly pertaining to the reductions and the additions, which you have covered after that. So thanks.
Perfect. Thank you, Jignesh. The next question is from Dinesh Kothavde. Dinesh, I'm unmuting you now. Please unmute yourself and please ask your question.
Yeah. So, Jigar, are you bullish on any sector specific now for this?
Right. So, yes, Dinesh. Clearly, see, India is still going to be a great story. The sector that there are a lot of sectors we think will do very well. But I think the one that sort of we are the most bullish on increasingly is the banking and financial space. Correct. Now, I'll just take a minute to explain the thesis on that. See, fundamentally, we see banking and financials as an industry where the sort of pivotal shift has happened after 2015. Right? Post 2015, there is clearly a space. Prior to 2015, banks were continually sort of greening up the facilities. And at that juncture, we realized that, there was no IBC, there was no real repercussions for the promoters to repay the loans, and a lot of unscrupulous elements did that thing. Post 2015, however, the AQRs were ordered. And after that, promoters actually started going to jail who wouldn't really pay up, and banks stopped evergreening. And since then, we are arguably looking at among the best placed sort of banking system channel today. Now, the way we analyze banking is clearly through the credit growth cycle, NIM cycle, credit cost cycle, as well as the valuation cycle. And in all of those parameters, other than I think the NIM cycle, where we would see some amount of contraction, things are looking great from across perspectives. The way in which it gets played, eventually the way we used to play it was to buy SBI in 2017 and ICICI Bank in 2018, and those continue to remain our preferred plays even today. But I think eventually there also came a PSU rally and the small cap banks rally, and I think all of that is in a place where things are looking great. However, I think given the small cap rally, a lot of participants now start thinking that it's not a great place to be in, and therefore they want the next round of multi-baggers. But for us, given that we are turning defensive, given that a large cap exposure is higher, we are a lot more focused and looking towards the sort of banking and financial space. Similarly, pharmaceuticals as a sector looks very interesting. However, I would say these are the place which looks good from the price as well as the sector fundamental standpoint. But there are a lot of places where the sector is great, like defense, railways, multi-year stories. But I think the prices need to come back to a little more moderate level for us to make a great company turn into a great investment. So we are waiting for those. Cap Good story has played out as a fund. We have benefited as well. That's interesting too. But I think these two, from a pricing standpoint, as well as from a sort of sector standpoint, look very interesting.
Thanks, Jigar, for this detailed answer.
Thanks, Dinesh. We have Amrita Shroff. I'm unmuting you, Amrita. Can you please ask your question?
Hi, Jigar. How are you?
Yes, very well, Amrita. How are you?
Good. Jigar, you partly answered my question in the previous answer which you have given right now, but I just want to ask on the HDFC Bank, particularly because I just want to understand what would be the downside and how you're looking the stock, because post-merger, we were quite comfortable around 1600 level. The stock took further hit, and still I'm not sure what would be the downside for this particular stock. So I want your little guidance on this, And
See
plus,
again,
apart
Amrita,
from this,
stock.
Axis, ICICI, all are taking hit. So where exactly the banking heading? Because I was thinking that Axis could be a better bet, but it is further creating a new lows. I just want to understand what will be the way forward for banking.
See, as I said, Amrita, see, company specific we can do at a sort of more one-on-one level. But I think, see, as a space, banking becomes a very interesting space. So as long as this small cap rally happens, see, one way to think about it also is that, and I will sort of, urge you to have a look at the article that we wrote. We did an analysis of the FII's largest overweight positions, right? And in that analysis, we could find that of the top 10 overweight positions, 6 are banks. Correct. Now, in that scenario, in the shorter term, I shared that slide when you saw from September and October.
Yes.
These sort of FIs have been sellers. And from that standpoint, they'll only sell what they own, right? It's not a reflection of their worth. It's the reflection of the flow. And I think the eventuality when this subsides, you will see a banking position which is reasonably good. So I think we should continue to be reasonably well present in that space.
Thank you. Thank you so much, Jigar. Yeah.
Thank you. Perfect. We have many more questions, but before I turn to that, let me take a few. We have almost 32 from the Q&A section. So I'm reading out a few. Amit Mehta is asking why US dollar is getting stronger. Ideally, all the factors indicate it should be weaker. Amit, I think these are sort of very long duration events that happen. Eventually, once the de-dollarization gets a little more wind, see today, almost 58% of the global reserves are still in the US dollar. From that standpoint, even if we achieve 1% per year sort of number, then we are still going to get into a zone where US continues to remain the predominant medium of transaction for the world. Plus, there are, even if you look at it from a traditional standpoint, the REER, the basis from which that emanates, your inflation differential over a longer term is expected to be much lower from that standpoint. So that's, I think, where we are seeing over the longer term, the US dollar will get a little weaker. But in the run up to that, given what's happening around the world, given the lack of opportunities that's still present. See, I started by saying that there was no alternative. But as US also starts preparing for a multipolar world, you are likely to see this scenario where China starts trading with a few partners in the renminbi or yuan as it's colloquially known. India says, okay, I don't have full capital convertibility, but let these 20 countries get together and talk within ourselves and transact in the rupee. So I think increasingly you are going to get a lot more de-dollarized as we go ahead. But those are not 1 to 5 sort of year trends. It takes a lot number of years to settle down. But knowing that this is the direction we are moving in, we think that being aware of that is the first part that allows you to identify the cycles at which we want to get positioned. Ayush is asking what would be the right index PE level to further top up on our PMS portfolio. See, index PE, Ayush, is a slightly misnomer, right? Because over the years, the index itself has gotten very, very, how should I put it? It's gotten smarter. So once S&P came into the index construction, you don't have the same assets being represented by two different companies. Like earlier, there used to be with Grasim and Ultratech and Tata Motor DVR. With all of this, it's become a little bit smarter. And actually 3 points. The second point is that the index itself became free float. So traditionally, those companies with lower float, which none of us can participate, would not really be the forming part of the benchmark. And third is the part where we are saying that the quality and the return ratios of the companies within the index itself has gone up. So looking at a historical benchmark, PE in India would continue to remain a little bit elevated. The way in which we are tackling this cash flow question clearly is that when I did mention that we don't run a model portfolio. So there are times when we are defensive, we take, sort of 6 months to fully deploy. When we are aggressive, we have deployed it in 1 week. So at your level, and we do keep interacting, Ayush, so we at your level, you can sort of decide on the allocation question, how much equity is within that, how much buoyant, and then allow us to sort of keep doing our part on that. There is someone anonymous who is asking, can we get this presentation? We'll try and see if we can put it up on the website. Hashnan has also asked the same question. Janit Shahadarpuri is asking, good afternoon, Jigar. My question is, how can you run different portfolio for clients since you don't run a model portfolio approach? Very interesting question. I'll sort of, turn it around and ask you that, look, if you are in that position where people are, looking at the markets and trying to constantly time the market, that sort of becomes a very tricky position for anybody, because more money eventually is lost waiting for a market correction than in the market correction itself. We did another study, and you will find one of these articles on our website as well, that imagine you are one of the smartest person on the block and you could time the market really well, and you invested all the money that you had at the bottom of 2009 crisis, right? The great global financial crisis. You were really smart. You could deploy all of it at the bottom of that market. And somebody, on the other hand, there was somebody who could not time it at all. And he said, okay, I don't really care, just spray it over 10 installments or something, right? And they kept buying across that downturn. At the end of 10 years, it might surprise you, Janet, that the difference between the IRR of those two investments, and for the ease of calculation, I've only taken the index as an investment. Over the course of 10 years, the difference in the IRR between those two investments was only 30 basis points. Correct. So eventually over 10 years, if the horizon is long enough, these timing differences is not going to matter. But by running a non-model portfolio, we are trying to tell you that you don't even have to think when to invest. By running one strategy, we are trying to communicate you don't have to think where to invest. And this way, running a non-model portfolio allows us for this. Logistically, it's a nightmare for most people. As I said, very early on, we started working with a tech company, and now we have a full solution in place where for the first year, the portfolio starts looking really different. But over the course of 12 or 13 months, whatever we are selling in the old portfolio would have been sold out. Whatever new we are buying in the new accounts will get evened out, and things become reasonably clear there. Does core performance reflect old money and satellite new money? No, Ramit, that's not how it works. When the stance changes, I should have mentioned that before, we actually test this very often for actual numbers. And in 2022, we did this exercise. So any account that was open with us for 2+ years, the returns were similar. So the average return, the time weighted, money weighted rate of return was 6.4%. The median returns were 6.1%. So that is not an accurate depiction of how this is run. What Pavit is asking, what is your view on pharma sector? There has been extensive buying into Indian pharma. Pavit, I would recommend you read our article written in April 2023, where we started from what really changed with the Hatch-Waxman Act in the 1984, what allowed Ranbaxy to file for the Lipitor generic, what led to the run-up into 2017, and then what led to the value correction, but we are reasonably interesting. What is the down capture ratio of the portfolio? Sachin is asking. Sachin, I don't remember it offhand. It's below 1 in the last 3 years perspective, but I'll try and respond to you separately. If we add new money, how much time will you take to deploy? A little bit path dependent, but as we see it, it should basically take us about 3 odd months to deploy. Manish Parikh is asking, can you elaborate a bit on core versus satellite? Manish, we have a different presentation for that. If you write to us at, info@buoyantcap.com, we will send across a detailed presentation and can schedule something to talk with you. Can we have this as a monthly thing? Shaila is saying, yes, we will definitely try. Monthly may be a bit too soon to do it, but we'll certainly try to do it at least every 2 or 3 months. How often do you churn the portfolio based on cycles? Arjun Sarkar is asking that. Typically, the churn tends to be somewhere around 30%. So that's where we are at. That's slightly higher, but I think churn has been given a very bad name. But when you account for the fact that buy and hold as a philosophy is not even being able to beat the markets on a consistent basis, then paying for that extra tax, the small 5% increase that we do on the gains is well worth the effort, right? In our calculation, I had written an article in one of the publications last year that basis what we are doing, at least we think we are making multiple times of the increased cost of churn in the basis. Is it Srinivas is asking, is it a right time to start a PMS? I'm assuming start investing in a PMS. Yes, I think, as I said, we don't run a model portfolio, so that's not really a big problem. Sorry, I'm trying to cover as many questions as I can. There are some 65 questions. Given all the uncertainty, does it make sense to have large portfolios now in debt for 1-2 years? Yusuf is asking that. Yusuf, that's a very different question to answer, right? Because allocation is not just dependent on the expected returns, but much more over the course of where your particular risk reward is relying at. Right? Once you decide on equity is an ongoing thing. Ideally, if you don't need money, and I'm sure a lot of portfolio managers tell you this, But I don't think you should weigh it basis debt versus equity. Equity reasonably remains very large, and over the course of 10 years, equity has delivered higher returns than gold, real estate, REITs, all other asset classes. I think next 10 years won't be any different. So I'm just taking questions like clearly what is the expected return for 1 year, and all those questions we can't answer. Shaila is asking, what is the impact of increasing AUM on future returns? Seems like you're moving to a range where it's difficult. We manage, Shaila, basis not just the size of the portfolio, but also how liquid we want the portfolio to remain. So even today, 65% of our portfolio is fully sellable on day one, assuming 30% volume participation. At that rate, we don't want to take more than 5% of the free float in any given company, and that allows us to remain reasonably flexible. Clearly 10,000 crores is too large a size. Given where we are, I think we are good to go for a few years at least, and eventually we will sort of stop accepting money in this scheme. What is your current view on IT sector, given that Infy has announced that they are shrinking hiring? Is Siddesh Kadam asking that question? Viral is the person who tracks this for us, Siddesh, but I'll echo what he's saying, that, see, IT is not cheap, it's not expensive, but it doesn't have growth. In India, we don't have tech, we have IT services. So when you evaluate it from a PE standpoint, it looks like, basically it's making a lot of sense, but we should not have rallied behind Nasdaq, and we did. So I think we are on the sidelines waiting for things to become a lot more clearer as we go ahead. Are you still optimistic? Arindam is asking on small cap IT and service stock. Yes, we continue to own that. We have reduced some exposure on our largest name, which is a ER&D business, Arindam, but we continue to own the other plays. Private banks or PSUs, again, specific, we own both, private and PSU within the top 3 companies. Can US NRI invest in your PMS? Anonymous, not yet, but we'll soon sort of have news for you in the next month or so. So please stay tuned. Arindam is again asking, apart from banks, do you prefer investing in cap goods and infra stocks directly? As I said, see, we still own a few of those, but not to a material level, because valuations are getting a lot questionable. Karan Kandhari is asking, you talked about political situation in states and countries' maturity to vote. Argument's sake, if the voter gives a shocker and BJP is toppled, what do you expect the impact for your PMS? See, again, it's a very tricky question, because the continuation at the center is something that is predicated, the market valuations are predicated on this. So I would say the markets are not really positioned today, Karan, for a BJP not even coming at the helm. With a lesser majority would have been accepted, but not completely, as I don't think that's what they are looking at. Naveen, I'm not taking sort of stock-specific questions, so we can sort of connect differently on that. Could you please share your views on EV sector as a whole? Dishant is asking. We again have written 2 articles on that, Dishant. We have broken down the entire ecosystem of EVs. So if you like reading on which company is doing what, you will find that article on our website. You'll also find that article on the Economic Times website. But I think as a play, it's fairly limited. The EV companies have also taken as a spray and pray measure. They have put up $1 billion with every company, hoping that one of them will grow to $100 billion and the other 9 will become zero. But we don't really understand that technology. We can't look that far into it. So spray and pray PE firms can do it. As a public listed equity, it becomes a little tricky. I'm sort of conscious of the fact that we had booked your time only for 1 hour, but I'm taking 3 or 4 more questions and then sort of move ahead. How much rally? Jigar Nandu is asking how much more rally is left in small and mid cap stocks, and is there still upside left in IDFC Limited? See, IDFC is one company that we did speak about. Clearly, banking space is reasonably good, but weight is a very sort of high priority for us. So weight is something that we manage reasonably well. And in that scenario, we want to run it in a place where the thesis is played out. In the first slide, I did show, that exit strategy is crucial to us. So great business still, but for us, the thing has largely been played out. Can you please, Bhavya Gulat is asking, can you please comment on the valuation of market in terms of large, mid, and small cap? Where do you see pockets of opportunities? Bhavya ji, we did discuss that. I think our portfolio is decisively moved towards larger caps. So clearly, that's something that we find a lot more value in. What is the timeline to deploy? As I said, 3 months. So you can leave it to us. We also have a SIP, STP model, so we can do that. Bhargav is asking, hi Jigar, is your current defensive stance only because of the relative valuation gap, or will it continue to be defensive longer considering the higher? So Bhargav, see, clearly the view was that if the interest rates stay higher for longer, then there are skeletons waiting in the closet to come out. And in that scenario, cycles will become shorter. So valuations in and of itself is very difficult to correctly understand and predict. Things that are expensive can stay that way longer than we can stay solvent. So that's not the sole basis, but as bottom-up analysts, we are finding it extremely difficult to bring that from this. A study done on your return distribution in last 5 years from core and satellite. It's put up by an anonymous attendee, but if you send us an email, we'll send across a presentation. This sort of analysis is part of the regular presentation. Arav Gupta is asking, the fund AUM has grown substantially over the past 3 years. Does it make it difficult to have large and small cap allocation? See, clearly, this is not a space where if you are running a 10,000 crore fund, Apurva, then you cannot allocate 7-8% of the capital that you want to allocate at will. But in that scenario, there is a sweet spot where we see ourselves. We sort of look at it from the available opportunity, as in the free float available vis-a-vis what we want to do, and we are still some way away from there. So very, very conscious of the question you are asking, but trust me, we are sort of having it under control. Anil Tandon is asking, how would you protect our capital if the world war happens? Anil, slightly difficult to answer that, but we will sort of discuss this separately. Vaibhav, shout out to Vaibhav, is asking, with the increase in AUM, would return perhaps start to dwindle? As I said, Vaibhav, yes. Going to sort of businesses that you always wanted, there is a sweet spot above which it doesn't work. We will sort of come to that separately. But we are, as I said, still a little bit away from that. Yogesh is asking, do you think performance of many companies is ahead of their actual earnings? It's just the DII flow leading to this rally? Yes, Yogesh, I think uncharacteristic, yes. Typically, markets having found a great investment want to reprice their asset fairly fast. But I think that's gone on slightly more because of the flows that a lot of the small and mid-cap funds are essentially seeing. But the way we approach this is that over longer terms, markets find whatever is unsustainable will find a way to topple. Correct. So clearly, 2018, what happened, right? There was just a long-term capital gains tax. They grandfathered the entire gains until 2018, but still the markets corrected after that measure. So the reasons will become evident later, but if it is not adding up on a bottom-up basis, things could become a reasonably difficult position. Again, gentlemen or ladies, we are not taking stock-specific question. Is it possible to post ET articles on WhatsApp of PMS? Yeah, Rika, we send this. If not, you can go to the website and just do subscribe button. Whenever we write, we will sort of send it over. I'm not sort of taking last couple of questions. I'll take. Anup is asking PMS returns versus the relevant mutual fund return. Anup, I think there are several websites that do that. As an independent house, we don't get NAVs for different PMSs. So I would urge you to look at this. Can you buy REITs or InvITs in your portfolio? Theoretically, we can, but we have never done. So not really sort of looking at doing that. If you are talking de-dollarization, does not gold become a significant allocation to a portfolio from a long-term point of view? Shiv said, yeah, Shiv, so sort of gold, but we need to take into account the alternative avenues. See, earlier in the 70s, there was only gold versus fiat. Now that is gold versus crypto versus fiat versus multipolar world. So not that gung-ho on gold, but again, not really an expert. Separately catch up on that. Are you planning to set up shop in GIFT? Not really at this juncture. So last couple of minutes, returns that you mentioned since inception are after fees and charges. Vikrant is asking that. Yes, Vikrant, SEBI is now very clear on how any PMS can report their returns. It is time-weighted rate of return per investor and money-weighted rate of return across the investment pool to create one pool NAV. That NAV is then used to calculate the NAV and fees, and these are post fees and expenses. Right. So I think that's all the time we had for today. Apeksha, you want to give out the closing comments?
Yes. Thank you so much, Jigar, for answering most of the questions that were posed on the Q&A box. And thank you everyone for attending this webinar. As rightly said by Jigar, we certainly look forward to do such webinars once in 2 or 3 months. So that we can, connect more and more. Thank you so much for being patient throughout the presentation as well. And have a great week ahead. Thank you so much, everyone. Thank you.
Thank you. Bye-bye.